Hey YouTube, welcome to Stocks in 5. Today's video will cover stock splits and how a 10-to-1 split would affect Amazon's stock. Before diving into stock splits, we first need to understand what the market cap of a company is. A market cap is the total amount of money a company is worth on the stock market. We calculate the market cap of a company by multiplying its total amount of shares on the market with its current share price. For example, if a company like Starbucks had 100 outstanding shares and each share was worth $10, then the market cap of Starbucks would be $1,000. Now that we know what a market cap is, the key thing to remember is that the market cap of a company remains unchanged whenever there is a stock split. So what is a stock split? A stock split is a decision a company makes to divide its existing shares into multiple shares. Let's go back to our Starbucks example and assume that Starbucks wanted to do a 10-to-1 stock split. Initially, Starbucks had 100 outstanding shares, each worth $10, giving them a market cap of $1,000. After the stock split, each initial share would be split into 10 unique shares. This would mean that Starbucks' share count would go from 100 to 1,000, explaining why we call it a 10-to-1 split. In addition, the price of the initial shares would also need to get divided by 10. As a result, each initial Starbucks share that was $10 would be split into 10 shares worth $1 each. To recap, that means Starbucks went from 100 shares each worth $10 to 1,000 shares each worth $1. And if we do the math, we'll see that Starbucks' market cap is still of $1,000, as expected. And this makes sense because a stock split doesn't affect the underlying assets and valuation of a company. It's just a way to make the stock more affordable. So even though the price of Starbucks shares went from $10 to $1 after the split, Starbucks' valuation did not get any cheaper because the company still has the same market cap of $1,000. So you might be wondering, what's the big deal about stock splits then? You see, even though a stock split should theoretically have no effect on an investor's outlook towards a stock, that's not always the case. For example, in 2020, two stock market giants, Apple and Tesla, decided to announce 4-to-1 and 5-to-1 stock splits respectively. It only took a month after the news for Apple's stock price to increase by 34%, followed by an 80% jump for Tesla shares. It's fair to say that a portion of these gains can be credited to the stock splitting, even though it had no effect on the company's fundamentals. In fact, studies have shown that shares of split stocks on average outperformed the market by 8% the following year and 12% over the next 3 years. The reason for a boost in stock's performance after a split can be attributed to a couple of things. First of all, a stock split announcement brings a lot of attention to the company at stake. The media coverage that a company gets after their announcement can translate to more hype and demand around the stock, which in return drives the price up. Secondly, the stock becomes more accessible to smaller investors. Let's say a company's shares were to go from $1,000 each to $100 each after a 10-to-1 split. A small investor would be more likely to purchase the shares at $100 because it would be less of a commitment. Thirdly, sometimes the stock split announcement is coupled with other great news for the company. This usually amplifies the gain in share price. Now that we know how stock splits work, recently there have been rumors about a stock split for one of the biggest companies in the world, Amazon. A potential 10-to-1 split would see Amazon shares go from its current share price in the mid-$3,000s to just above $300. Amazon hasn't had a stock split in over 20 years, and investors believe it is due for one, as the company enters a new era with Jeff Bezos stepping down from the CEO position in late 2021. This would be big news for retail investors who don't have access to fractional shares, as they would be able to buy a full Amazon share at a much more affordable price. As for previous shareholders, they would see their number of shares owned increase by a factor of 10 to reflect the new share price after the split. Furthermore, the stock split could reinforce Amazon's position as one of the market leaders because it would be eligible for an inclusion in the Dow index, known for tracking 30 of the largest companies on the stock market. Also, the extra liquidity in shares would make it significantly easier for investors to sell options, since option sellers are required to own at least 100 shares of a stock to participate. This would lower the barrier to entry from nearly $300,000 to around $30,000. All in all, an Amazon stock split announcement in the near future could possibly result in a share price rally and would provide a solid opportunity for retail investors to get exposure at a more reasonable share price. Whether Amazon stock splits or not, the e-commerce giant is a market leader that is worth taking a look at when building an investment portfolio. With that being said, that's all for this video. I hope you learned something new and thank you for watching.